So Ryanair stock just took this massive 7.4% nosedive in a single day.
Yeah, a total bloodbath on the charts.
Right. And it really begs the question, like, are we looking at a terrifying falling trend flashing all these red sell signals? Or is this just, a heavily undervalued strong buy that's disguised as an absolute disaster?
Well, I mean, that really is the multi-billion-dollar question playing out on the tape today. It's April 17, 2026, and the market is having this visceral, almost violent reaction to the stock.
It's totally, completely fractured out there.
Exactly. You have major institutional whales aggressively buying in, and then other whales are just dumping millions of shares. And the technical charts, they literally look like an absolute battlefield right now.
Yeah, the narrative is a mess. So our mission for this deep dive is to basically cut through all that noise. We're going to unpack the financials, decode the underlying technicals, and try to settle this fierce bull and bear debate surrounding Ryanair Holdings PLC, ticker symbol RYAAY.
It's going to be a fun one to tear into.
Definitely. But hey, before we rip into the numbers and figure out if you should be buying this dip or just staying far away, make sure you like this video, subscribe to our YouTube channel, and you absolutely must leave your comments and feedback down below. We really want to know where you stand on this one.
Yeah, let us know. So to figure out if this is like a classic retail value trap or maybe a generational buying opportunity, we have to start by surgically separating the company's real-world financial health from the immediate market panic.
Because those two things are entirely decoupled right now.
Completely decoupled.
Well, let's explore that disconnect then. Because, when a stock drops over 7% in a single trading session, your immediate assumption is always that the underlying business model is fundamentally broken.
Yeah.
So does the actual ledger justify that level of fear?
Well, the financial reality paints a surprisingly different picture, at least when you look at the top-line growth. If we examine Ryanair's trailing 12 months, their TTM revenue, they brought in $17.43 billion.
Wow, okay.
Yeah, and that is up significantly from their fiscal 2025 revenue, which was $14.99 billion. So the top line is undeniably expanding. More people are flying. The volume is clearly there.
Right, the planes are full.
Exactly. And for FY25, their net income sat at a very healthy $1.74 billion.
Okay, so the planes are full, the money is flowing in. So what triggered this 7.4% sell-off then? Because the market doesn't just panic over $17 billion in revenue.
No, it doesn't. The panic actually stems from a severe margin collapse that caught Wall Street completely off guard.
Oh, I see.
Yeah. The latest Q3 2026 earnings per share, the EPS, it came in at a pretty dismal 7 cents, and Wall Street analysts had modeled it at 18 cents.
Wait, okay, missing a target by 11 cents might sound trivial to an outsider, but on an 18-cent projection? That's, what, a massive 62.78% miss?
Yeah, it's a huge miss. Wall Street models are supposed to be precision instruments, When a company misses by that wide of a margin, it tells the market that either management doesn't have a handle on their costs or the environment is deteriorating faster than anyone predicted.
Right, and it's usually costs, isn't it?
You hit the nail on the head. Even though top-line revenue is growing, Ryanair is fighting, these really aggressive labor renegotiations across Europe, plus soaring ground handling fees and elevated maintenance costs.
So it's just chewing through the revenue.
Exactly. Chewing through it before it ever reaches the bottom line as profit. That 62% miss, that was the catalyst for the 7.4% drop.
But dropping an entire stock by over 7% over one single quarter of squeezed margins, that feels like a huge overreaction if the foundational business is stable.
Yeah.
How does their actual balance sheet look once you strip away that one ugly quarter?
Well, the balance sheet is really where the bear thesis starts to run into a bird wall. As of March 31st, 2025, Ryanair is sitting on $17.51 billion in total assets.
That's massive.
Yeah, and crucially, they have a massive cash position of $4.17 billion in cash and equivalents.
Okay. Having over $4 billion in cash is serious leverage. But what about liabilities? Because airlines are notoriously capital intensive. You have to constantly buy planes, fund maintenance, pay for terminal space.
Right. Usually legacy carriers are leveraged up to their eyeballs with debt just to keep the lights on.
Exactly. So where is Ryanair sitting?
That is their defining structural advantage. Their debt-to-equity ratio is currently sitting at 0.02.
Wait, really? A 0.02 debt-to-equity ratio for a global airline? How are they financing these massive fleets without taking on all the crushing debt that their competitors are drowning in?
They're funding their growth almost entirely through their own cash generation. Their annual free cash flow for FY25 was $2 billion.
Wow.
And for the recent period ending December 31st, 2025, it actually spiked 50% year over year to $2.5 billion.
That is insane. I mean, when you generate $2.5 billion in free cash, you just don't need to beg the banks for high-interest loans.
Exactly. You're completely self-sufficient.
You know, it's like, okay, let's unpack this. It sounds like an Olympic sprinter who just tripped on their shoelaces at the starting block. Like, yeah, it's embarrassing in the short term, but their underlying conditioning is still elite.
That's a great way to look at it.
Right. It's like entering a severe recession with a totally paid-off house and a vault full of cash while all your neighbors are stuck with high-interest, adjustable-rate mortgages.
Yeah, exactly. When times get tough, your neighbors have to scramble and raise their prices just to pay the bank. But you have the absolute freedom to slash your prices, completely undercut them, and just buy up their assets when they go under.
So that fortress balance sheet is basically an offensive weapon.
It absolutely is. It allows them to weaponize downturns. But the problem is that long-term operational strength is doing absolutely nothing to stop the short-term bleeding on the charts, which is why we have to look at the tape.
Yeah, let's transition to that price action. Because if the underlying ledger is a fortress, the daily chart looks like a crime scene right now. Where do we actually stand?
So as of April 17th, 2026, the stock is trading at 57.38, and that price is hovering uncomfortably near its 52-week low of 44.51, which is a really steep fall from grace, considering it hit a high of 74.24 recently.
Ouch. So the short-term trend is just severely bearish then.
Very. We are looking at a 20% decline year to date and a 9.7% drop in just the past week alone.
Jeez. When a stock is dropping that aggressively, you have to look at the institutional order flow, right? Because the retail market doesn't move a multi-billion-dollar airline by almost 10% in the week. Who's buying and who is capitulating?
Well, we're seeing an intense institutional tug-of-war right now. Major support is sitting right at the $57 psychological level. There are massive buy orders stepping in to defend that line.
Okay, so there's a floor.
Sort of. But there is incredibly heavy selling resistance waiting just above it, around $63. So the stock is essentially boxed in between those two walls.
If it's boxed in like that, it means the biggest asset managers in the world are fundamentally disagreeing on the future of this company.
Yep, and the data confirms that split. Take Baillie Gifford, for example. They're one of the most prominent asset managers in the world, and they recently dumped 16% of their stake in Ryanair.
Wow, that is a massive institutional exit.
It is. But simultaneously, Capital Group aggressively went the exact other direction, raising its stake above 14% in March 2026.
Okay, so we have giant institutional whales taking totally opposite bets. If the fundamentals and the smart money are completely split, what is the technical analysis telling us? Are the indicators providing any clarity at all?
Honestly, the technicals are screaming mixed messages right now. Let's look at the momentum indicators first. The moving averages are triggering a strong sell across the board.
Across the board.
Yeah. The stock is trading well below its 5-day moving average at 62.9, its 50-day at 61.75, and its 200-day at 61.05.
Okay, so for anyone tracking the broader trend, when a stock is trapped beneath the 5, 50, and 200-day moving averages, it means the selling pressure is entrenched across every single time frame, short, medium, and long term.
Precisely. And the MACD, the moving average divergence, confirms that exact sentiment. It is deeply negative at minus 1.61.
Let's break down the mechanics behind that MCD number. A negative 1.61 doesn't just mean the stock is going down, right?
Right. It means the short-term price average is diving significantly faster than the long-term price average. It tells us that the selling isn't slowing down at all. The selling momentum is actively accelerating.
And that accelerating downward momentum is exactly the trap. Because if you look exclusively at the 14-day RSI, the relative strength index, it's sitting at a very low 28.10, right?
It is.
So this is where the tension gets incredibly dangerous for a trader. The momentum indicators show accelerating selling pressure, but an RSI under 30 indicates a stock is deeply oversold.
Yep.
If the charts are fighting themselves like momentum is screaming sell, but the RSI suggests it's oversold, isn't this the ultimate trap for a retail trader? You see that low RSI, you assume the selling is overdone, you step in to buy the discount, and then the heavy institutional momentum just runs you over.
Oh, absolutely. It's the textbook definition of catching a falling knife. You assume an oversold technical reading guarantees an immediate bounce, but a stock with negative momentum can remain technically oversold for weeks or even months while it just slowly bleeds out.
Which really forces us to look past the technical noise and ask the harder question here. What is this company actually worth? This brings us to the great valuation debate. Is Ryanair deeply undervalued at 57 bucks? Or is this a classic value trap where it looks cheap but is actually destined to go lower?
Let's build the undervalued argument first. The PE ratio sits at a modest 11.5x. That is safely below its 5-year median of 12.4x.
Okay, so historically cheap.
Very. And furthermore, if we look at Guru Focus, they calculate the GF value, which is the intrinsic value of the business, at $60.2. That makes the current 57.38 price roughly 4.7% undervalued on paper.
You know, in a broader market where growth stocks regularly command PE multiples of 40 or 50, paying 11.5 times earnings for a company with a fortress balance sheet and basically zero debt feels like a structural discount.
It really does.
And the analyst community seems to agree with that thesis too, despite the recent price collapse.
Oh, they do. The analyst consensus currently holds a moderate buy rating with an average 1-year price target of 80.54.
Wow, $80.
Yeah. Top-tier firms are completely looking past this quarter's EPS miss. JP Morgan recently reaffirmed their buy rating with a target of 36 euros for the European-listed shares. And Evercore ISI maintains an outperform rating with a target of $80 for the American depositary receipts.
Okay, so we have Wall Street analysts projecting a path to $80, but the overall market sentiment index for the stock is officially registering as fearful. Why is the broader market so terrified of a company with $4 billion in cash?
Because the fear isn't based on Ryanair's internal ledger. It's based on massive external macro headwinds that threaten the entire aviation sector right now. First, you have rising global jet fuel costs.
Always a big one.
Yep. Second, rival airlines have started reporting surprisingly soft summer bookings. The market assumption is that if competitors cannot fill their planes for the peak summer travel season, Ryanair is going to suffer the exact same demand destruction.
Well, I'm going to challenge that assumption, going back to our paid-off house analogy from earlier. If consumer demand drops and the middle class is squeezed, travelers don't just stop flying altogether, they trade down.
That's a fair point.
Right. A family that might have flown British Airways or Lufthansa will pivot to Ryanair just to save money. Ryanair's low-cost model historically absorbs market share when macroeconomic conditions tighten.
Yeah, that historical resilience is definitely valid. But the third macro headwind is the geopolitical risk in the Middle East.
Ah, right.
Any escalation there threatens to spike crude oil prices overnight. And that destroys margins regardless of how many passengers you steal from competitors.
Fair enough. So we have the theoretical analyst targets and the broader market fears. To figure out who is actually going to win this institutional tug-of-war, we really need to look at the concrete operational reality. What are the specific catalysts actively playing out inside Ryanair right now?
Okay, let's step into the cage match. The bull catalysts versus the bearish risks. The bull case for a massive recovery is built on aggressive, planned expansion. Management just laid out their fiscal 2026 outlook, projecting traffic growth to increase by 4%, hitting 208 million passengers.
Okay, so they aren't retreating in the face of a tough quarter. They are actively expanding capacity.
Exactly. Expansion is the goal. And simultaneously, they're executing an ongoing 700 million euro share buyback program.
Okay, let's break down the mechanics of a 700 million euro buyback really quick.
Right.
Because it is so vital to understanding those $80 price targets.
Go for it.
So when a company uses its cash to buy its own stock off the open market and retire it, they shrink the total number of shares in existence. It's like taking a pizza and cutting it into 8 slices instead of 10.
Exactly.
The overall size of the company hasn't changed at all, but your individual slice just got significantly larger and more valuable. By reducing the share count, Ryanair mechanically, almost artificially, boosts their future earnings per share, even if their net income stays flat.
Yep, it's a massive lever for shareholder value. But the linchpin to their entire growth strategy relies on fleet modernization. They are expecting delivery of highly fuel-efficient Boeing 737-8200 aircraft.
The ones they call the game changers, right?
That's them. These planes carry more passengers while burning significantly less fuel. If crude oil prices rise, operating a vastly more efficient plane is the ultimate operational cheat code.
But that cheat code relies entirely on Boeing actually building and delivering those aircraft on time. And this brings us directly into the bear case.
Yeah, the downside risks are severe, and they start on the ground. European air traffic control fees are rising, and labor costs are squeezing margins, which we saw in that 62% EPS miss.
Right.
But the catastrophic risk involves Boeing. Boeing is currently paralyzed by major production strikes. These labor disputes are directly delaying the delivery of those game-changer planes right before Ryanair's critical, highly profitable summer season.
Yeah, how do you hit a projection of 208 million passengers if the manufacturer literally cannot deliver the planes required to fly them? I mean, if Ryanair is banking its entire 2026 growth story on aircraft that are currently stuck on a Boeing assembly line due to a strike, aren't those $80 price targets built on a total house of cards?
That bottleneck is the primary source of the institutional fear we are seeing on the tape right now. You cannot recognize revenue on seats that do not exist. But the bear case gets exponentially worse when you examine their long-term fuel strategy.
Oh boy.
Ryanair currently has zero fuel hedging in place for FY 2028.
Wait, none. Zero hedging for an airline operating in this crazy geopolitical climate.
Absolutely zero. They're completely 100% exposed to long-term fuel volatility.
Okay, for context for you listening, fuel hedging is a financial strategy where an airline buys futures contracts to lock in the price of jet fuel months or even years in advance.
Yep.
It basically acts as an insurance policy.
Right.
If global oil prices spike due to a war or supply shocks, the hedged airline is protected because they locked in a lower rate.
Right.
So is operating with zero hedging in 2028 a massive oversight by Ryanair's management? Or is it like a deliberate, aggressive macro bet?
It appears to be a deliberate, almost predatory bet.
Yeah.
If global tensions cool and crude oil prices drop by 2028, competitors who locked in high-priced fuel hedges will be forced to pay artificially inflated prices.
Oh, wow.
Yeah. Meanwhile, Ryanair, paying the cheaper spot price, will see their margins absolutely explode. They'll have the capital to slash ticket prices to the floor, essentially trying to starve and bankrupt their overhedged competitors.
That's savage.
Yeah.
But, I mean, if they are wrong and oil spikes to, say, $120 a barrel, Ryanair is going to be paying premium spot prices for every single drop of fuel they burn. And that $4 billion cash pile will evaporate incredibly quickly.
It is a high-wire act with zero safety net. When you combine unhedged fuel exposure with Boeing aircraft delays and accelerating labor costs, this 7.4% stock drop actually makes perfect sense.
Yeah, it really does.
The market isn't just reacting to a bad quarter, it's actively pricing in the very real possibility of a worst-case operational scenario playing out over the next 2 years.
Okay, so let's synthesize all of these conflicting signals here. We have the fortress balance sheet against the Boeing delays, the oversold RSI against the negative MAX-ED momentum. What is the outlook? What timeline should you, the listener, be focusing on right now?
So in the short term, meaning the next few days to weeks, expect intense continued volatility. Because the RSI is sitting at 28, a technical oversold bounce is highly probable.
Right.
The stock could easily jump up and retest that $63 resistance level as algorithmic traders take profits on their short positions. However, the macro headwinds, specifically fuel prices and the Boeing strikes, remain in absolute control of the narrative.
So any short-term bounce might just be a technical relief rally before the downward momentum resumes.
Exactly. The short term is a trader's battlefield.
What about the medium to long-term outlook for investors then?
Looking out toward the end of 2026, the structural outlook actually remains fundamentally bullish, aligning with analyst expectations of a recovery toward that 82.39 target.
Oh, interesting.
Yeah, the foundation of that thesis is purely the balance sheet. Having $4 billion in cash and virtually zero debt ensures Ryanair can survive a brutal, high-cost environment that would literally push highly leveraged competitors into bankruptcy. They are financially positioned to outlast the storm and absorb the market share left behind.
Basically, they don't have to be perfect. They just had to outlast the legacy carriers.
Exactly.
Now, it is absolutely imperative we state clearly that this exploration of the data, the institutional flows, and the bull-bear dynamics is entirely for educational and informational purposes. None of this constitutes financial advice. You must examine your own portfolio, respect your own risk tolerance, and conduct your own rigorous research before you allocate a single dollar to the market.
Absolutely. The data and the tape provide a map of where the institutions are fighting, but interpreting those signals for your own portfolio is your responsibility alone.
Well said. We've covered the underlying ledger, the moving averages, and the crazy geopolitical gambles today. But to close this out, I want to leave you with one final provocative thought to mull over.
Let's hear it.
We know Ryanair's 0.02 debt-to-equity ratio makes them an absolute tank. And we know they are weaponizing a zero-hedge fuel strategy for 2028. But if these Boeing production strikes stretch even further, bleeding deep into the 2026 peak summer schedule.
Yeah.
Exactly how much of Ryanair's projected top-line revenue is going to be left sitting completely grounded on a Seattle tarmac?
I mean, the most efficient business model in the world cannot generate yield if the aircraft are never delivered.
Exactly. Keep digging into the numbers, keep tracking those heavy institutional support levels, and thank you for joining us on this deep dive. We will see you next time.